A big down day on Wall Street, but take a look at what worked today. Apple shares ending the day up more than 3%. So is this the ultimate safety trade? Let's get to the Chartmaster. Carter Worth to break it all down. Carter.
Well, you point out the single most salient and important data point up today in a tape that was exceedingly red, which is to say no one has to buy or sell, unless, of course, you have a margin call. And the fact that people chose not to sell Apple in and of itself, and actually to buy it, third highest volume day of the year, means a lot. So let's look at a chart or two, a table or two, and try to pull it all together. Basically, the first one, Apple is essentially a laggard that is just coming to life. So the top panel is Apple, and you see it's been ascending, but the bottom panel is something altogether different. Apple has basically been dead flat and underperforming to some extent, the S&P for the better part of 12 months. So take a look at the table that comes next, and this really puts it in context. This table shows the performance. Apple had a blow-off peak in September of 2020. And those numbers are very stark, right? From September 2nd, 2020 to present, Google's up 73, Microsoft up 46, S&P up 30, and Apple up only 23, meaning it's been a real laggard since that blow off. Now take a look at the next slide, data table. But what's happened over the past month? The exact opposite. You have tremendous performance from Apple. So relative strength, one of the great factors in investing, is showing us that something is going on. Now, three charts. An Apple chart that picks up the COVID low, no judgments or annotations by me. Next chart, let's draw some lines. One way to draw the lines, this is what my eye sees, and we are moving above that upper bound. And then the final chart, it's a short-term chart, it really puts it all in context. This is the definition of a breakout, a textbook move to a new high. So if you look at all the factors that one can look at, earnings revisions or valuation or balance sheet leverage, over time, one of the great factors in investing is relative strength. Today's relative strength in and of itself is nothing short of shocking.
So back to Microsoft, Carter. I couldn't help but to notice the big gains that we saw at 46% and then unchanged over the past month. Is that just a rest, and is that a positive sign actually for Microsoft?
Well, so Microsoft's been obviously a great performer, but it's not exhibiting the same characteristics day to day, week over week that Apple is. I would rather be in Microsoft than the S&P. I'd rather be in Microsoft than a lot of broker dealers or other cyclical stocks that are showing real distribution. But if one had to choose between Apple and Microsoft, by my work, Apple's the winner.
A self would you rather, which I will allow. Carter, thank you. Carter Braxton Worth of Worth Charting. Would you make the same choice, Karen Feinerman?
Well, I have them both. So I don't know. I guess not then. I have them both. I keep them both. I think they're both great. And yeah, it's not a terrific answer, but that's my book.
I guess it's like asking which child you love more. Dan Nathan.
Exactly. I do have a favorite, though. But no.
Dan, I'll ask you then.
Just kidding.
Yeah, I think the more interesting question, Mel, and Carter just said he'd rather own Microsoft than the S&P 500. I'd actually rather own the S&P 500 for a lot of what we've been talking about is the poor breadth. We already have a lot of stocks that have been marked down. I think there was a stat about how many stocks are more than 50% of the S&P 500 are down more than 10% from their recent all-time highs. So to me, I think you have the idiosyncratic risk of any one of those two names that have gone up straight up. They have gained like $1 trillion in market cap, those two stocks, in less than 2 months. So to me, I think there's risk there. If there's any reason to have any hiccups in these Q4 results or their 2022 guidance, I'd much rather not have that idiosyncratic risk and be in the S&P.
I guess it also goes to which adventure you choose, Tim, and you outlined a couple of them in terms of, do you want to be in the sort of the reflation trade on the belief that there's going to be greater inflation, or do you want to be in this sort of secular growth trade because you're seeing economic growth slow down?
Well, I would rather be in the reflation trade and call it a value divergence that Dubravko talked about. But if I may, would you rather, would you rather, I'd rather have Amazon. Because, again, if I look at the underperformers relative to the S&P, Amazon's up 9%. I actually think Amazon has withstood some really tough comps. and is in a great place in terms of the secular tailwinds around e-commerce. Apple, by the way, has outperformed the S&P by 72% over the last 2 years. You can pick your spots, but I like a nice 2-year run to really tell the full picture. Apple hasn't underperformed. It's outperformed. And therefore, I think Amazon, which really was so far ahead of everyone early COVID, is the name. And I'm sorry I did that, and I know I will get in trouble.
You're not sorry, because you did it. I mean, it's done. So, Guy, you know what? Choose whatever stock you want. Go ahead. Microsoft, Apple, Amazon, S&P, whatever you want, Guy. What do you think?
Yeah.
So you're upset at the others, so you take it out on me. I'll play your game correctly, going back to the original thing. I'll point this out about Apple. This flight to safety, flight to quality, whatever you call it, traded 175 million shares today, just to put a fine point on what Carter mentioned earlier. That's more than 2 times normal volume. So what's going on here is the fact that people are fleeing clearly the broader market and finding their way into Apple. If you think the broader market is going to stop going down, then I think you're inclined to take profits in Apple. How about them apples, Mel?